Hi, I'm Sam Slater from Fund Calibre, and today I've been joined by James Ashley, Chief Economist at Goldman Sachs Asset Management. Hi, James.
Hi, Sam. Thanks for inviting me to join you.
You're very welcome. So if we go straight into it, last week, US inflation surprised by coming in high and also higher than expected. So perhaps you could tell us what's going on and why someone in the UK should worry about US inflation.
Yeah, well, why don't I take those in reverse order? Why should we in the UK care about US inflation to start with? I think the US market, particularly US inflation, is the gauge, the bellwether of what's driving international markets, whether it's UK, US, or pretty much anywhere else in the world. So even though you might have a UK focus in your portfolio, what's happening in the US market is going to have some impact, some spillover and ripple effect. In terms of what's happening, there are two distinct elements and one questionable third. What you're seeing in the US is base effects, which I'll explain in a second, bottlenecks, and perhaps some, if you like, quote unquote, genuine demand-driven inflation. So the base effects, I think the easiest way to explain this is just to think about how much does it cost to fill up your car. So forget the US for a second. Just think about you in the UK, how much does it cost to fill up your car? It probably costs you about 125 pence a litre right now. And if you went back to the start of the year, it might have been somewhere around 120. So it's gone up marginally, but not dramatically over the past 4 or 5 months. Problem is, if you go back last year, we all remember that oil prices were cratering, petrol prices were collapsing on the back of that. So if you go back a year, you're probably paying somewhere closer to £1. So if you're looking at prices today compared to prices a year ago, then it looks as though prices have moved dramatically higher, and indeed they have. But that's really a reflection of what happened a year ago when prices were falling rather than anything that's happening right now. That's what we call these base effects. So when you're comparing prices today compared to prices 12 months ago, you get this spike in inflation. That's going to be temporary. We know that that's going to be here for probably the next couple of months, and then that will start to fade away. Then you say, well, what about the bottlenecks? The bottlenecks are something that perhaps have got a bit more longevity associated to it. This is things that perhaps are related to the pandemic, where orders were cancelled or fragmentation of supply chains meant that things aren't in the right place. And things are getting pieced back together now as we revert to some semblance of normality. And that might take a bit of time. And until things are fully reintegrated, you might have these dislocations where there's a pinch point where demand is exceeding supply. So you've got these bottlenecks as well. And then there's a third element, which we're yet to really see coming through, but we might see over the course of the next few months, where as people have been cooped up for the past 12 months, being told that they can't go out and spend, they can't go on holiday, they can't go to sports events or concerts, they've accumulated all of this savings, it might be that as things are reopened and liberalized in the second half of this year, you get this surge in demand, and firms take advantage of that by increasing their margins and increasing their prices. So in terms of what's happening so far, it's really a story about base effects and bottlenecks, but we shouldn't be blind to the fact that there's a possibility of demand-driven inflation coming through in the second half of the year.
And in terms of US inflation and what that actually does to stock markets and bond markets, what happens there?
Yeah, so the big concern here is that if you get this sustainable pickup in inflation, I think the market can look through 1 or 2 months of inflation. As you said, Sam, we had this spike in inflation last month. We're probably going to see another couple of months of high inflation. If it's just a temporary 2 or 3 month period, the market looks through that and says, we're going to focus on the medium term, nothing to get too excited about here. If you see this sustained pickup in inflation, the concern from a market perspective is, well, hang on, is that not going to force the US central bank, the Federal Reserve, to change their strategy? Rather than saying we're going to keep interest rates super low for a super long period of time, maybe for another 3 or 4 years, if you get this sustained pickup in inflation, is an inflation targeting central bank not going to say, well, I guess we better raise rates sooner rather than later? So the concern from a market perspective is if you look at equity market valuations that are all predicated on really low rates for a really long period of time, if that assumption starts to be questioned, you could potentially see a correction in equity market valuations. And equally, if you look at this from a bond perspective, if you expect interest rates to be moving higher, then you should be expecting bond yields to be moving higher and therefore bond prices to be falling somewhat. So if you have a situation where high inflation forces the hand of a central bank, then that has a potential big impact on both bond and equity markets. So the key question is, how likely is that? How willing are central banks to look through this temporary spike of inflation?
And from your perspective, from Goldman Sachs' perspective, how likely do you think that is?
I think there's quite a high degree of likelihood associated with that. And there's a number of reasons why. I mean, in the interest of trying to be relatively succinct, I'll keep it short. But if you're thinking about what central banks are explicitly saying now, the Federal Reserve in particular, and we're having a conversation here focused on the US, they've come out and said, look, we're changing our framework. The way that we responded to inflation in the past is not the way we're going to respond to it in the future. We're going to do two things. Firstly, on inflation itself, we're going to assume that inflation needs to average 2% over the course of a cycle. So if you've had this prolonged period over the past several years where inflation has been a bit too low from their perspective, they're now saying if inflation runs at 2.1, 2.2, 2.3, that's okay. That's not going to cause us to hit a panic button in the way that it might have done historically when we were strictly targeting 2% inflation. So we're going to allow a bit of an overshoot. That's okay, but we can live with that. And the other thing that they're now explicitly saying is, look, instead of being so focused on inflation that that's the be-all and end-all, we're going to put more emphasis on what's always been there in our mandate, but has that perhaps had less visibility, which is the full employment criteria. We're now going to pay much more attention to labour market conditions. And of course, we expect the labour market to bounce back strongly this year, but is it going to be a full bounce back, or is that going to take some considerable time further? So the Federal Reserve, the US central bank, is looking at this environment and says, look, things are getting better. Thankfully, blissfully, things are improving. But how long before we get back to full employment? How long before we simultaneously have inflation sustainably over 2%? Not because of these bottlenecks and base effects, but sustainably over 2%. And their message, forget what we think, forget what you think, but their message, their assessment is that's probably a couple of years in the future. So we're going to be dealing with relatively elevated inflation this year, but there's going to be slack in the labour market. By the time the labour market starts to get a bit tighter, inflation might be coming back down again as we're looking into 2022. And therefore, we get to the situation where it's perhaps 2023 or 2024 before you have that combination of circumstances where the Federal Reserve is saying, okay, now perhaps we need to think about raising interest rates. So our assessment would be, don't expect rates to stay low forever. Absolutely not. But I think in the short term, the Federal Reserve and most, not all, but most of the central banks will also look through this temporary spike in inflation because they do indeed see it as being temporary rather than anything that's sustained.
And given what you've said, what asset classes do better in this type of environment?
Yeah, and that's the $64 million question, is it? Our view is that equities are the place to be. If you think about what is driving the market right now, is this assumption that rates are going to be low for a long period of time. Well, I've just said our assessment is that that's probably going to be validated. That's probably correct. At the same point in time, that as we emerge from the depths of lockdown and the worst of the pandemic in the US and in Europe, at least, I recognize there's a lot of pain still being felt in other parts of the world. But as we emerge from the pandemic in Europe and the US, we're starting to see earnings growth for many sectors coming through very, very forcefully, sectors that have been suppressed for the past 12 or 15 months. So that combination of strong earnings growth and very low interest rates for us points towards equities being a relatively attractive place to be. And even in an environment where inflation does tick up above 2% sustainably, that's actually quite helpful. It has been historically from an equity market perspective. Moderate inflation is something that's quite helpful for firms thinking about increasing margins or raising prices. Where you're dealing with ultra low inflation rates, that tells you something about an economy that's being crippled, it's really on its knees, it's really suffering. High inflation, that's really difficult because that's eroding profit margins. That sweet spot of inflation varies from one economy to the next, but somewhere in the range of 1% to 3%, that's pretty good for equities. So our view would be that equities are likely to outperform bonds over the next 12 to 18 months.
And within equities, I suppose two questions. Would you favour emerging markets over developed markets? And do you think the value rally's got further to go?
I think emerging markets have got a lot going for them. I mean, start with valuations to begin with. Obviously, there's an enormous dispersion. You can't say all EM is a certain valuation. We think about the valuation of UK stocks differently from US stocks. We don't just lump them together and say developed markets. So within EM, there's a huge dispersion. So you've got to be thoughtful about how you position within that. But generally speaking, valuations are more attractive than in developed markets. We are in a situation where, although rates have moved somewhat higher, market rates have moved somewhat higher in recent recent months, we're still dealing with very low interest rates by any historical standards. And I think many emerging markets now have got a lot of upside. There's a lot of bad news priced in. And I think that's in many cases entirely appropriate. But in terms of what's the news flow likely to be on a forward-looking basis, is it likely to get better or worse? We're of the view that things are likely to get better. So I do think that emerging markets start to look quite attractive in this kind of environment. Of course, you should diversify across emerging and developed. That almost goes without saying. But we do think emerging market assets do start to look attractive. Growth versus value, I tend to think that for this year, there might be a bit of benefit to having a slight value tilt. That we're not a growthy house or a value house. I'm quite agnostic on this. We'll just call it how we see it. But in an environment where you're going to get this strong growth for this year, you're likely to see, as we talked about, elevated inflation, and rates have moved slightly higher. That tends to favor value style equities rather than growth. Medium term, I think growth will go back to outperforming. But our key message on growth versus value would be don't be so dogmatic about it that you're only going to invest in one or the other. Just look for attractive companies that have got a good valuation with strong medium-term earnings prospects that you believe in, rather than saying, I will only invest in this particular segment or silo. So I think there are opportunities in both. Put a gun to my head and say which one. I'm going to lean towards value right now, but I think that there are opportunities across the market.
That's great. Thank you very much.
Thanks, Sam.
And if you'd like to find out more about Goldman Sachs funds, please visit fundcalibre.com.